All right. Good morning, everyone. It is Monday, March 10th, 2025. The time is daylight savings time, 9:15 a.m. Everybody loves that. Don't have a stroke. Don't crash. I hope everyone's having a good start to the week, even though it statistically sucks. But hey, I hope everybody had a good weekend. I hope nobody's dying in these markets. I hope your hedges are doing well. Why so early? It's a thing called daylight savings time, Mr. Soul. Uh, Funny, Discord didn't adjust, so I had to manually adjust the times in Discord. Discord doesn't care about daylight savings time. Right, so let's have a look at pre-market tape. S&P futures are down 1.33%, NASDAQ down 1.6%. The Dow is down 1.07%. The Russell is down 1.13%. VIX futures are up 7%. Short-term treasuries up modestly. Long-term up pretty good. 20 years up about 1%. 30 years up about 0.8%. Gold is flat, interestingly. Maybe got a little bit carried away past several months. Crude is up 0.28%. Nat gas is up 3.3%. Bitcoin is down 4.85%. The FTSE is down 0.67%. The Nikkei closed down 0.24%. Shanghai Index closed down 0.31%. And the US dollar is down 0.11% versus other currencies. Welcome to the beginning of a bear market. Again, good morning, everyone. Hope you had a good weekend. I know I did. Markets seem to be dying. But yeah, I took on a good amount of leverage through the dip. Had some losses in the meantime, and then as of Friday, I went right back up. Well, not just on Friday, but yeah. So basically, I'm flat from when the market started to drop. But speaking of my positions, I have started to wind down. Well, not started. I've almost wound down. Does that make sense? I've almost liquidated nearly the whole portfolio that I manage. So now I'm talking about the fund that I manage, not my personal funds. So probably won't be too many trades. I probably won't be doing these talks too often, to be honest. They might be impromptu. We'll see. But yeah, in case the markets are going nuts like this, then maybe I'll come on. In addition to typing stuff in Discord, which I hope you find useful. A lot of it is straightforward, but I think it's the things that people forget, like always buy the dip. And I think as of today, SPY's down over 10% from all-time highs. That wasn't the case Friday. I think it was like about 9% Friday. And statistics show that buying a 10% dip in the SPY is a good idea. And it's an easy way to beat the markets. So a lot of people forget that when everybody starts turning bearish, they just say just sell, short anything, short the SPY, short NASDAQ, short the Russell, whatever. Everybody starts going on the news, and that's the classic time that you should be buying the dip. I pointed out in that little blurb on Discord that just because it's a great time to buy the dip, or saying that doesn't mean the markets aren't going to keep dropping. Like, not at all. just means you're literally averaging down on the SPY, which for speaking purposes is the single best security you can purchase. So you can dollar cost average into. So that's it. If it goes down another 10%, you buy more. If it keeps going, you buy more, and that's how that goes. That's that. And then over the long term, hey, maybe we get V-shaped recovery like we've been getting the past several years. Or even if we don't, over the long term, you're going to be glad you bought the dip. And that's it. People are always waiting to buy dips. And then when there's finally a dip, everybody's too scared to buy. And everybody wants to sell. So, yeah, just a reminder. Yes, markets are looking shaky. Skew predicted this, by the way. Another win for Skew. For those who don't know, Skew is an indicator. I'll type it in here. It's literally SKEW. Meant to be looked at on a daily basis. And Skew is an indicator of how expensive puts are relative to calls on the SPX. And when it gets really high, say a number over, 150, that means markets, institutions, retail, they are all hedged quite a bit. And then they're paying money hand over fist for that hedge being puts on the S&P. I would say 150 is typically quite high, but recent years it's gone up to 170, and 170 seems to be sort of like a new level. As in, once it hits 170, that's when the markets are predicting a sizable downturn or, somewhat of a correction. And every time it hits 170, the markets do correct, at least by 10%. So it hit 170, I believe it was back in September. And I've done some research on it and analyzed some of the data going back since they started Skew, which I don't think wasn't too long ago. We might have 15 years. Yeah, just under 15 years, looks like. But when Skew hits a certain level, say like 170 now, historically, not the most amount of data, but so far it's been reliable. But historically, when it hits 170, that means we're going to see at least a 10% drop in the S&P from all-time highs somewhere between the next 6 to 12 months. And it seems to be most prevalent between 6 to 9 months. So today, or around this past week, 2 weeks, wouldn't you know, is right at the 6-month mark from when Skew hit 170 back in September. So Skew is, it's doing its job for me. It's serving as the best indicator for predicting downside in the markets. One of the keys to it is that just because Skew, say, predicts that the markets are going to drop at least 10% in 6 months from now or 9 months, whatever, doesn't mean they're going. It doesn't mean you buy puts as soon as Skew hits 170, because a lot of times the markets will continue to go up. So it is actually helpful to try to time it, but as I'd say with anything as it relates to betting on downside in the markets, don't turn it into a big trade. This isn't some Michael Burry big short type deal. This is, you should be hedged. You should always be hedged, especially if you're taking on leverage. And at some point when you get that indicator from Skew, maybe increase the hedges a bit, or make sure you don't take them off, whatever. If you're pulling out cash from your portfolio for whatever reason, just keep in mind, hey, Skew gave an indicator, and you need to maintain your hedge. At least maintain it, dial it in, make sure it's, if it's, say, unit puts, far out of the money puts on the SPY, make sure it hasn't gone too far out of the money, make sure to, reload on those or reposition those. And let's say Skew hit September. Skew hit 170 in September. Yeah, I was starting to position myself late last year. I'd say beginning of this year. Yeah, in January. And then February, I started beefing them up, and that seemed to be a pretty good idea. But I don't always go in SPY puts. I had a pretty big short on Tesla, which I've closed, and I wouldn't be surprised if it keeps going down. To be honest, I just closed because I have to move money. But yeah, and then there are the cash burn stocks that I report on for my wealthy donors. So yeah, and you can do a mix as long as it's not some crazy percentage of your portfolio or whatever your preferred hedge is. You don't have to do any of those. Or maybe some of you really like the idea of shorting Tesla. So yes, we're seeing, in my opinion, the first leg down, and I'm not going to try to time every single movement in the markets or whatever, but skew has again hit really high levels. It's been hitting high levels since December, like a bit manic, I think. And it's not too hard to believe if you consider how the price movement on stocks, on meme stocks, on small caps, it's been ridiculous. I've said it a few times. I am in disbelief. It doesn't look like real price movement to me. Even the stocks that I picked, like Robinhood, I would say Toast maybe a little bit, but Robinhood has been one of those. But it has been linked to crypto quite a bit. But there have been plenty of stocks. Even stocks that I'm right on, I'm like, I don't believe this price movement. I don't think they should be moving that much. So skew hitting high levels again, indicating that the markets should drop, or should have another drop at some point in the near future over the next 6 to 9 months. Yeah, that makes a lot of sense to me. The level's a bit higher. Hit 170 in September. And then it started hitting like 175 in December. I mean, it was sitting above 170 for like a week. Then it hit 180 late December, 180 again in January, 183 in last month. I don't know. I wouldn't say like, oh, it's going higher and higher. That means the drop in the market is going to be, even more severe. I don't know. I don't have any data to support that claim. But it does indicate that markets are still paying a lot of money for hedges, and it could be in large part due to retail, because there isn't a tremendous amount of volume on those far out of the money puts. I assume more and more retail are hearing about hedging and, okay, I'm just going to buy far out of the money puts. That's how they bet on upside. They just buy way out of the money calls. So they probably have the same mentality for hedging. Okay, I'm just going to buy some cheap way out of the money puts. The funny thing is, it's not the worst logic. It's a hell of a lot better than just buying way out of the money calls. So the skew indicator could indeed be skewed by retail trading, by just, excessive fear, what have you. But the fear seems somewhat justified at this point. You always need a catalyst. People will say every single year, every other month, markets are too high. They're overextended. They need to come down. Valuation is too high. Leverage is too high. You hear this. It's the same thing every quarter, every year. But markets always need a catalyst to start to move down, and it's usually something unexpected. When it's expected, the drawdowns are typically, I would say 9 times out of 10, they're not as great as people would fear. So if everyone's expecting the markets to come down because Trump, well, they're already coming down. We've had a 10% correction of the SPY. But maybe we're just flat for a little while, Maybe we come back up and then we go back down, as skew predicts. So I wouldn't bet the barnyard on shorting stocks and thinking that SPY is just going to melt, right? Just keep a good hedge. And based on skew, we might have more drops coming up. Maybe starting as early as May, maybe June. I mean, it's been sending that signal, since late November, just about late November. So yeah, Could be May, could be June, but again, it's not an exact science, and it just tends to be 6 to 9 months out is when we see at least a 10% correction. And again, it doesn't mean that it's going to be more severe. It doesn't mean we're going to see 15%, 20%, 30, whatever, but it has always been at least 10%. So just remember that. You hit 10%, maybe start unwinding hedges, maybe start buying the dip, but just be cautious if you're going to try to stick to one or the other, or don't unwind all your hedges at down 10% and start loading up, right? So just be prudent about it. Keep some hedges on if you're going to buy. If you're not going to do anything, then just sit there, right? Keep your hedges, keep your longs, whatever. And you could just ride it out, and that would be fine too, as long as you're hedged over the long term. So yeah, that's your Monday morning pep talk while Trump kills the markets. Right. So what else we got? All right, SPY is looking okay right now. I have very few positions compared to what I usually have, but I am making just a few trades. So let's see. I did buy SPX call spreads at the open. I had that set to fill this morning. But yeah, I'm sort of, what I'm seeing right now is it looks like the start of a bear market, but longer time traders are going to say, all right, we haven't gotten all the signals yet. People that are more focused on the long term, I would say, okay, just wait a second. Like 2 weeks, 3 weeks doesn't make a bear market. But it definitely could be the beginning of a bear market. I've seen some intraday movement that looks like maybe it's the start of a bear market. I've seen there have been some days I'm just selling the hell out of put spreads, and it just works. And the markets recover midday, something like that. So to me, my eyes, doesn't quite look like a bear market, even though we just kind of went down a staircase from recent all-time high. So in addition to skew and having those interim upward price movements from the time that skew says markets are probably going to go down 6 to 9 months from now, and the times that they actually do go down 10% or more. Like I mentioned, the markets, they tend to go back up. And a lot of times they reach a new all-time high. So that wouldn't surprise me, and it doesn't mean we can't then proceed to drop again, right? Another thing to consider right now is, statistically speaking, once we hit a 10% drop from recent all-time highs, now we're below 200-day moving average. We're set for a rebound based on historical statistics. So I always prefer to go off of statistics, probabilities, than headlines. And I think despite what a lot of people would say, yeah, but look at the tariffs and look at Trump's policies and look at what Canada's doing, this and this and that. The question I would ask is, what do you think the markets are not pricing in right now? What do you think they're not expecting? And I say pricing in, but don't look at the price, but the direction, and tell me that you think the markets are unaware of the consequences. And if you say they are unaware, I think you're unaware. So the markets are definitely aware. So this goes back to expectations. If something happens that the markets are not expecting, then yes, we're probably going to go south. The statistics on the 200-day moving average, 10% from all-time highs, doesn't matter, right? Even skew maybe doesn't matter, right? But I think all of this, if you're seeing it in the headlines, if you're reading it, then the markets expect it. So just keep that in mind. Don't try to over-predict. The market's already down. Do what you will. If you want to trim some hedges, you want to get a little long here, it's not a bad idea. But just keep your portfolio balanced. Don't be Don't get blindsided on another 5-10% move down or anything like that. And ignore a lot of headlines. Ignore. I guess this counts as social media, but I'm speaking from textbooks and the veterans that actually know their stuff and have been in the game for over 30 years. So those are the guys I take my cues from, not a Reddit post or whatever. So yeah, just ignore all that crap. It's just gonna make you want to FOMO or sell or whatever. So yeah. Keep calm, keep cool. Yeah, and just rely on statistics. Don't try to make any crazy calls. All right, well, I'm going to put my soapbox away. Kevin, you cashed out almost entirely last week. Why did you do that? Didn't you just sell your house? Aren't you about to get a boatload of money? If you cashed out last week, I would put some money back in. Oh, you bought it. Okay, you sold a house. Oh, I thought you said you sold a house. Okay, my bad. Yeah. Well, I hope your house outperforms the S&P. Let's see. Yeah, SKU hit 180 in December, and it hit it maybe 3 times. Google. How's Google looking? They're being pushed to sell Chrome. Is that right? And DOJ decided they can keep their AI business. How nice. It's right back. Yeah, this is the same level it was a week ago. When I mentioned I think I like Google at this price. So interesting. It's kind of holding. Yeah, personally, I'm not going to make too many trades. I just came to talk. I thought maybe I could soothe nerves. You still have 10% of your cash on hand in Schwab. Yeah, fucking move out of Schwab, man. Who did anybody like that bug over the weekend? My account went to $0, which is a pretty big decrease from the total amount that's actually in it. But yeah, everything. No, we haven't fully liquidated, but that should. Yeah, unless I want to just play around this week, that's probably going to happen this week. So yeah, I'm basically I'm good to go. I just have just like a dozen positions that I need to just get rid of. Nothing crazy. I think I got to sign on some JP Morgan. How are they doing? They're getting beat up. But yeah, maybe you know what? Maybe I'll trade some JP. This is how it happens. Let's do some. Oh, man, 235. How are we looking on the charts here? JP Morgan, almost at 200-day. It's oversold. Okay. Yeah, this is that's a little crazy. I'm gonna go a little aggressive here. I do want to keep it tight though. Okay. Buy some or sell some put spreads rather. And then how about some just going short term here. Man, these calls are expensive. I didn't have a lot of luck with calls over the past few weeks on JP Morgan. I think I'll go light. They are quite expensive. I'm not a fan. I think I'm just gonna sell vol. I would normally do like I might do call spreads, but yeah, I'm not liking the spreads on the debit side. That is, yeah, not a fan. All right, what else we got? Let's look at the flex grid. Okay, Broadcom. Broadcom could not hold at 200 level, could it? Apple's down 3.2%, 3.3. Google's down 3.75. Meta's down 3. Microsoft's down 2.17. Nvidia's down 1.5. JP Morgan's down 2.8. Broadcom down 1.9. Amazon down 1.75. So Apple's taking a beating. Microsoft's been taking a beating. That just doesn't. Let's see. Apple, Google, and Microsoft. Apple's got China to worry about. Google has the DOJ to worry about. Microsoft, I guess, has AI to worry about. But I'm going to make a trade in Microsoft. And I'm going to go aggressive. All right. I should get there we go. Okay. That took longer than I thought. Okay. Man, these calls are expensive. Maybe I could do a ratio spread. Or back spread. I don't like that either. What do I see Microsoft? I could see it. Let's say 400. Oh, that doesn't give me anything. Yeah, maybe not. I like selling vol right here. I think that's probably what my play is going to be. SPX spreads are doing well. I didn't buy too many. Okay. How's Tesla? How's that piece of shit? Let's see. Down 5%. Holy hell. Let's see. How often has it been oversold like this? Look, the 1 day, 5 year. Man, it was just last year that it was trading under 140. Sorry, it was trading. What am I looking at? Yeah, last year was trading under 140. 2023 was a shit year. Man. Crazy movement. I think Tesla is the only stock you need to look at if you need to try to figure out if the stock price movement has been rational. what was this? Pre-election, it's about 210. Went to 488. What was that in a month? 2 months? Yeah, 2 months. Went up something like 100 or 130%, and it's already dropped almost 50%. Good night. A deserved drop. Yeah, Tesla should not have been trading that high. That's just yeah, that was mania. That was Trump mania. Irrational exuberance at its finest. Yeah. Look, I don't think Tesla. I mean, it's tough. Look at IV. IV's like maxed out now. IVR. It's tough to short stocks like this, and I wouldn't want to go contrarian on Tesla. Yeah, the only thing I would do is if it was oversold on like the weekly chart, then I would say maybe make a contrarian trade. Or if you're already shorting, then I would say hedge. Buy some, get some long deltas on top of that trade. But it's pretty close. I would say it's probably close enough. If you're shorting Tesla, I would, and it's a sizable position. I think now's a pretty good time to put on some long deltas. And for those who aren't familiar, that the reason I'm putting it that way is because I'm not saying that I think the trade is done. I'm not saying to bet on upward price movement because it's oversold. And like close your short entirely. Yeah, I would just hedge. I would keep a short position, frankly. And I would just have a nice hedge on. And then go out like at least 1 month. Maybe do like 1 month, 2 month call spread, something like that. Pretty wide, something that gets you a pretty fat return. Let's see. What do we got here? How are those SPY put spreads doing? I got a lot of carrying to do. Come on, Thinkorswim, work with me. All right. They're only making about 50%. Is that right? Yeah. Okay. Yeah, I do not feel like making a bunch of trades personally. I mean, I don't need to. But yeah, I will sell some vol though. Yeah, Google's right back down. Google will probably continue to be choppy. I don't think they're trying to get Google to sell Chrome, right? Like that hasn't actually happened. But I don't think there's been a ruling on that, but I think if they just split up, that'd be fine. I suppose they just don't want to lose their dominance as one of the mega caps, but yeah. Right. So, we had our bear market talk. I don't want to talk too much about tariffs, to be honest. I would just say, yeah, Canada is at this rate, Canada's going to win the trade war. Canada just elected Mark Carney as a new prime minister, and I think he's going to be tougher. Trudeau, I guess he didn't have a lot of time to implement any retaliatory trade policies, anything like that. But yeah, Carney, I don't think he's going to be too kind. So we'll see what the loony does. But yeah. Really bad trade policy. You don't have to be an economist to know that. Yeah. So, right. I think that's all I got. SPY heading back down, looks like down 1.4%. I will probably sell some. What time is it? It's not even 10. Maybe I'll sell some put spreads. I don't know if I want to go for the dailies, though. The dailies have been precarious. Those, I mean, you got to get out once you're making 30 to 50%, which is, 50% is a great return, but there were a few times I was like, I'll let them go. And I just thought to myself, like, why the hell did I do that? Like, I know better. I've been doing this long enough. Let's see. Okay, I think I'm going to go for the 5680s, 10 wide. It's a bit early, but I'm not going to sell too much. What I would say is, okay, am I in? Look at that. Look at this slow thinker swim down. I do not have a lot going on right now. All right. Yeah, I'm gonna take that and then I'll double down if it drops another. Well, I guess now if it drops another 10 bips, yeah, down at 1.6% down. I'll throw in some more. All right. That's all I got. Let me check YouTube real quick. I forget you guys are there. Cam, I see you. Yeah, I'm like way late on your comments. Can I talk about some of the textbooks I recommend? Sure. Hello, Andy. Hello, Keeper. Hello, LL. Yes, I've been doing these every week, and then today I said I might not do them anymore. But yeah, we'll see. Some textbooks. With regards to what? Because I don't know if you're still here, Andy. I don't even know when you type that. But textbooks for what? For trading? For trade policies? Economics in general? Supply, demand? I don't know if Andy's still here. Andy popped in, asked that question, and then left. Yeah. I'm not sure what textbooks or what subjects you want to cover. I mean, in general, there's so many textbooks, and there are only, I don't know, maybe a handful that I read, like basically cover to cover. But I've read chapters of, I don't know, several dozen. And I've found something useful in most of them. I obviously I couldn't name them right now off the top of my head, but I mean, if you're looking at just stocks, like everybody quotes the Intelligent Investor. I think Intelligent Investors. I think that's like philosophy. I think it's quite outdated. Um, so Intelligent Investors, it's more. Uh, yeah, I mean, I don't even do that type of analysis anymore. Buffett, he doesn't even invest that way anymore. So like, I think that's a pretty that's kind of evidence that the Intelligent Investor is a bit outdated. I mean, he does it for other reasons as well. Frankly, he's too damn big to do the same type of value investing. But with accounting changes and everything, since that book was written, yeah, it's just it really isn't the same. Markets don't just move the same way they used to. So, Intelligent Investor is more like philosophy, like what not to do, what to look for, sort of. And it's financial health, strength, long-term performance of a company, right? Kind of basic stuff that everybody likes to ignore, but it is helpful. Security analysis is good for investing, for value investing, growth at a reasonable price. Security analysis covers quite a bit. What is it? It's the investment banking, like, sort of Bible written by. Let me see if I can find it. I don't remember the whole name. Let's see. Is this it? It should be it. Okay, yeah. Investment banking valuation, leverage buyouts, and mergers and acquisitions. This book here by Rosenbaum and Pearl. This was the book that basically, like, when I was in college, if you wanted to get into investment banking, this is basically where you started. This is a great start, and it's very practical. I know it says investment banking, but frankly, most of the concepts are highly applicable to just investing as a retail trader, a retail investor. It shows you how to look for comps, comparables. How to compare your company to other companies, to its other peers, how to find its peers. A good amount. I wouldn't quite say qualitative, but it is a bit qualitative, like knowing which companies to compare your stock to. And then obviously it covers a lot on the valuation part. So this is very useful, not just for the formulas that it provides. That's useful in investment banking and private equity. But just having an understanding of why we use those formulas, why we use those valuations, and knowing that you have to compare. Like it's always relative. So yeah, it's very good. It's very good at helping you to know how to research companies. I know a lot of people, they just say, a lot of people praise DCF. DCF is in this book, but frankly, it covers a lot more than just DCF. So when people are just like, it's just all about DCF, they're kind of like, I don't know. To me, it's the equivalent of saying somebody says, eat your fruits and vegetables, and one person won't shut up about strawberries, and that's all they ever talk about. It's just eat strawberries, and that's all you need. It's like, there's a lot more to it than that. So yeah, it's a good book. I've read that like front to back multiple times. It's a reference. It's a really good reference. But yeah, helpful for financial modeling as well. Very helpful. Let's see. The as far as just trading goes, I mean, everything I read related to volatility and treating a fund or your portfolio like an insurance company. The Option Traders Insurance Company, I think that's literally what it's called. Let me see. Option Traders Hedge Fund. Sorry. Two on the nose there. This book, if you're new to selling volatility, selling options, or you're kind of stuck on the long side, this is a pretty good book. It's a very good starting point. It does have some advanced terminology, so it's not exactly beginner friendly. But if you are an advanced trader, then you would see it's like, yeah, okay, I kind of know a lot of this stuff. But yeah, it does talk about trading volatility, obviously selling options, because it compares your portfolio to an insurance company, which is extremely fair. That's what options contracts are. They're just priced a hell of a lot better than insurance. So yeah, this is a great book, and even though it focuses on the idea of selling, which is correct, mind you, it is option selling is basically, that's where the edge is, right? So it's correct to look at it that way, and from that angle, you get a good understanding of what it means to go long options and how to do that. So just picking random strikes and saying like, oh, gamma max, or oh, max pain, whatever, like you're guessing. And institutions don't trade based off of these concepts or whatever. Gamma, for example, I see people reference gamma over and over and over again. It can be useful in seeing where volume and open interests are on option strikes, but none of it means that that's going to happen, because every time you look at it, it's a snapshot. It's always a snapshot. It's not predictive. So it's more about trends. So yeah, a book like this, it kind of, if you're going crazy about long options, because usually the reason people are looking into gamma, max pain, stuff like that, it all relates to buying options, like always. So there's already inherent bias, because they're all just going to try to frame all these concepts around the idea of buying options, when in fact, if you're not an option seller to some degree, you don't have an edge in these markets. You probably do not as a retail trader, frankly. Me with intuition maxed out, like the best it's ever been, yeah, it's tough to be an options buyer. But yeah, so that should tell you something. Like, there's inherent bias, and it's always long. So yeah, you have to consider both sides. And markets change, data changes, numbers change. So yeah, if you're using any of those indicators, they're just, bear in mind they are snapshots, and they do not represent what's going to happen. And things always change. So yeah, this book kind of brings it back sort of to basics, I suppose. And then from this, I would say you could build an understanding of how to use long options, how to actually buy and be smart about it. Because every time you buy an option, you're not thinking like, how much money could I possibly make? You're thinking, what's the probability that I don't make money? And that's how you should be thinking. Frankly, those are the best traders, not the ones that are saying, I'm going to make so much money on this or whatever. The best traders prioritize risk, and period. Like, there are no exceptions about that. I didn't make it, 12 plus years in this career by just throwing money at calls and saying, I think I could make a lot of money now. No. That's not how that works. Okay, so that one's good. What are the volatility books? Is it Trading Volatility? What's the big one? There's like a big purple one, or maybe they changed the color. Options Volatility and Pricing. That's the one I was thinking about. There are a lot, by the way. But Option Volatility and Pricing by Nattenberg. I haven't referenced this in a while, but I haven't changed up my volatility trading strategies in a long time. But yeah, this is very helpful. My bread and butter strategies were volatility based, and that was basically what got me my job, would secure my job as a It's a small time hedge fund manager. So yeah, if you can trade volatility, if you know what to do with volatility, you're kind of like if you can show that you can use volatility to make money in bull markets and bear markets, you look like a wizard to people that don't understand. So trading volatility, understanding how to trade volatility in bull and bear markets is essential. It's crucial. And again, it comes back to risk management. Risk management first, and then probabilities, And if you can be consistent, then you can generate consistent return. And historically, I basically closed all my whatever volatility strategies I had on the table back in August. Yeah, if you can be consistent with those, you can maybe some years you don't beat the markets with those specific strategies when we don't have any volatility, right? And the markets are just up 25+% or whatever. And maybe you only make, my volatility strategy only made 15-20%. It's still pretty damn good. And if you could be consistent year over year, then yeah, you look like a wizard. So for me, I was basically with the volatility strategies I have, I could basically expect at a minimum 10% a year, unless I screwed up, 10% a year, and for that particular strategy, not as for my whole portfolio. And if volatility was, if it was pretty decent, I could make 20-25%. And then there were 1 or 2 years it was 30 to 50%. I think one year was a little bit above 30, another year was about 50, and it was just, I think that was when was that? 2020? Yeah, can't remember. But yeah. So my specific volatility trading strategies, I haven't had a losing year. Not since I became an actual professional trader. So yeah, volatility is king, and the what you tell investors or whatever is it's an asset, and it's the only asset that has a real negative correlation to the S&P, to markets. And as an asset with a negative correlation to the markets, to the S&P, it's incredibly valuable. And it has to be a part of your portfolio, period. So, and that's why you hedge, right? It's kind of the same idea. Everybody that's trying to hedge against downside in the S&P, they're just trying to get that negative correlation. Well, you have it. It exists. It's volatility. And that's it. That answers that question. So if you can learn how to trade it, then yeah, you're incredibly valuable as a trader. So yeah, that's what I would say. I would say those are the. I don't want to cover too many books, but yeah, I got at least a handful of textbooks on my bookshelf. But yeah, some of the books like Complete Turtle Trader, that's sitting on my desk right now. I used to be vehemently against TA. And the only thing I ever found was that the only thing that's been proven for TA would be very long-term strategies. And it's mostly the basic concepts floor, resistance. We're talking 100-day, 200-day moving averages, stuff like that. And then momentum and volume. So outside of that, I haven't seen anything that's evidence. I haven't seen anybody say this strategy's been tested, this intraday strategy, and it works. It's the 5-day and the 12-day and whatever. I haven't seen any research, any of actual credible white papers analysis of those strategies that say they work through any type of market over the long term, which is what you need. That said, Turtle Trader. It's about some traders that were taught by this Goldman Sachs guy, very good trader. Just random people pulled off the street, basically taught them how to trade, and now I don't know, like a third of them are multi-millionaire hedge fund managers. Um, so yeah, this is helpful, and it does teach some of the basics of trend following, trading trends, and yeah, and they use a lot of the basic indicators for trading based off of technical analysis. Even like the guy that's basically most famous, I forgot his name, but he's done like interviews. Yeah, I forgot his name. He's got a parrot. He lives somewhere in Texas. He basically owns like a town. Um, but he insists on, I think it's like 100-day, 200-day moving averages, and that's it. And yeah, and he said they've tested all sorts of strategies, and that's it. That's what he's been using for decades now, and it just hasn't really changed. And he's knocking it out of the park every single year. So yeah, this book is good for the TA guys. Honestly, I would say this book over, I don't know, like the crazy TA, or even like that technical analysis book. What is it? A technical analysis? Is that just the name of the book of stocks, or which one is it? Technical analysis of the financial markets. I think that's the one. I think this is the one. The one that has all the charting and all the patterns. Like, I read that a while back, and then I was like, this is bullshit. But yeah, there's good luck finding white papers on cup and handle formations, to see if that works. But yeah, technical, that type of stuff, it's astrology. So yeah, stick to the basics, long-term moving averages. Yeah, Turtle Trader, that's a good place to start. Yeah. All right. I got nothing else. I think that's that's good enough. There we go. We're down 1.67%. Okay. Time to sell some more spreads. And I'll go in the money. I don't quite want to, actually. Let me see. You know what? I'll go in the money. That's fine. Be a little ballsy. Oops. Nope, that's not what I want. Thinkorswim. I cannot wait to leave this platform. Look how slow this is. Crazy. Okay. And look at that. It's rallying as I'm trying to get in, isn't it? Let's go 15. Yeah, it's rallying. Let me see. I'm going to do 5. Man. Thinkorswim is awful. It still won't get me in. Now I'm below mark. It's changing like crazy. If this doesn't go, then I don't know what the hell will. Yeah, it's starting to run away from me. Look at this. This is insane. I can't even get filled because the platform's too damn slow. I put it below mark. Now I'm going to have to take a price I don't want to take. Insane. Never had this problem on Tasty Trade. Ever. Oh,
Good
who's
morning.
that breathing into the mic? It's Andy.
Am I?
Andy, you come on right as I'm about to leave.
Well, you just invited me.
I didn't invite you.
Yeah.
I'm not the only one
I
that
got a
can invite.
notification that said you have been invited to speak.
I didn't invite you. I'm not the only one that can invite.
All right.
All right.
Okay. I got you. Gotcha. Someone else invited me to speak. I don't know.
Yes, correct. Um,
That was me, C405.
I answered your question. I don't know if you
I
heard
don't.
all the books.
Yeah, you did. I heard it. Yeah.
Okay. And I
Thank you.
was gonna leave before that. So yeah, now I'm definitely leaving. Weather's
All
looking
right.
pretty nice outside up here.
Bye.
I might get some coffee or something, treat myself. But yeah. All right, ladies and gentlemen, I am done for probably the week. I don't know if I'll do a Talk Friday, to be honest. If you missed it, I am winding down my fund.
hmm
So, yes, probably no Talk Friday.
Congrats.
But yeah, maybe impromptu talks here and there. I don't know, but we'll see. But all right then, have a good week, everyone, and don't blow your portfolio up in these markets. All right, I'll see you guys.
Bye.